All right, gonna go ahead and get started with step 4, finance and due diligence. So it's just some general guidelines when you're looking at doing a loan, and it will vary depending on the loan type, the lender, things like that. But from a general perspective, the net worth of the guarantor or guarantors, meaning more than one people, people can come together to do this. But you'll say you're doing a $10 million loan, then the net worth combined of all the people that are going to sign on the loan, as they call it KP, key principal guarantor, needs to be 100% or more of the loan amount. So in this case, $10 million or more. That's a general statement. Post closing liquidity, meaning after I close on the deal, maybe I'm going to invest money in the deal, things like that, needs to be 10% or more of the loan amount of the guarantors. So $1 million or more liquid. Some cases, if you're a foreigner and things like that, it can be up to 30%. That's what some banks want to. Just depends. But some things don't count either. Like you exclude your real estate you own, 401ks, retirement plans. You get to a certain age, I think it's like 52 thereabouts, can't remember. Sometime in your 50s. I'm there now, so I know because it happened to me. And they said, "Oh, we'll start counting half of your retirement funds because you're so old now, basically." So it does start getting counted at some point. I guess it's an advantage of getting older, but that would count. And then there's certain things that just don't count. Like life insurance policies typically don't count, stuff like that. So it's a little bit different per bank. Time to complete a loan, 30 to 60 days. 30 is really short. I mean, a lot of bridge lenders probably can do it in 30 days, but even now, that's tough to do. The more scrutiny that's being placed on the market today for borrowers and properties and performance and questions. I've never seen anything like this before as far as how many questions all the lenders are asking now. 30 days would be really, really tough. Okay. 60 days is tough for some loans as well. So, in fact, this is extreme. It's a property that we owned and we did a refi on, went into a HUD loan, good and bad, a lot of positives to that, and some negatives to it too. But it took 19 months to execute that loan. Those are real numbers. 19 months from application to completing the loan. So, trying to buy a deal, you can't probably ask the seller, "Hey, you want to wait 19 months for me to get a HUD loan?" No, that's not going to work that way. They have things like bridge to HUD, or you just go into a bridge loan, then go to HUD later, and things like that. So, loan to cost will range 60 to 80%. 80% is pretty difficult right now to get. 65, 75 is what we're seeing for the most part. And what does that include? Does it include, CapEx money, yes or no, things like that? A lot of cases, no, it doesn't. Bridge lenders are still giving it, but like Fannie and Freddie typically are not giving money for CapEx, things like that. So some financing tips: use a mortgage broker. I explained what they were before, but it's where you use, someone that goes to the marketplace and very savvy and types of loans that might fit a certain deal, things like that. And they get charged, they charge you for that, you pay them for that, and you should pay them for that. The correct loan type for the project, if you're like, well, I'm going to buy this deal and I'm going to get a Fannie loan and but my goal is just to fix it up and then sell it after 2 years. I'm going to get a 10-year Fannie loan. I probably wouldn't do that. For one, your prepayment penalty on a Fannie loan would be just astronomical. Now you could say, well, I know, but some of the Fannie loans, I can actually sell it and have somebody assume the loan and it would have a bunch of time left on it. Well, that's true too. But what if you come in and you buy a property today at 5.1 interest rate, and for whatever reason, 2 years later, interest rates go down to 3%? Your loan's not very attractive anymore to a new buyer. So the correct loan for the correct type is very important. You could argue the reverse. I'm buying a property, it's stabilized from an occupancy standpoint, but I'm gonna, redo the interiors. I'm gonna do like all this stuff. I'm gonna put $50,000 a unit of capex into the property, and you want a Fannie loan for that. Well, that's fine, but you're going to have to realize you're going to be raising all the money yourself due to the capex. Okay. Recourse versus non-recourse. Recourse is, probably self-explanatory. It means that you sign on a loan as a guarantor, key principal guarantor, and it's full recourse. If something happens in the property, you can't perform, and or there's some sort of, issues, the lender can come after you and sue you personally, your personal assets. No question asked, full recourse. Non-recourse sounds really nice, right? Non-recourse debt. You mean I can sign a $100 million loan? There's no recourse to me personally because the lender treats that as a business and they can take the property, but they can't do anything to me. They can't come after me, like Mark, can't come after me. Total lie. Yes, it's non-recourse, but it's non-recourse with what's called carve-outs. And usually sometimes they're called bad boy carve-outs. And some of those are obvious, right? If you go out and steal or you're fraudulent on what you're giving to your lender, of course. I mean, yeah, you should get in trouble for that. You should get recourse coming after you personally because you're a liar, right? And you're you're a thief or whatever you want to say, right? But without going into all the details on it, there are many, many bad boy carve outs in your loan documents, and you need to make sure you understand those before you sign your loan docs. And you need to change or try to change any bad boy carve outs that you're not comfortable with within reason. Right. You're not going to get a lender to say, hey, we're not going to come after you, a mark, if you steal and you're a thief. And well, of course they're going to, right? But how about like a completion guarantee? Okay, so this is legit. You have a completion guarantee. You have a 1 year to rehab 40 units out of 100 units. You said you're going to do that, Mark. You didn't do it. Bad boy carve out your completion guarantee. We're coming after you. Coming after you means what? Coming after you personally. Not just the property, coming after you personally. Okay, next question would be coming after me personally to what level? What I mean by that is let's say the completion guarantee said for whatever wasn't complete. So we had $1 million of capex and we did $800,000, but $200,000 left that was never completed, should have been completed. Some cases, the completion guarantee could be, hey, Mark, coming after you for $200,000. Other cases are like, nope, coming after you for full recourse. Oh, you mean the $1 million for the capex? No, that's not what I mean. Your loan is $20 million. We're suing you. We're going to sue you personally for $20 million. Full recourse. Bad boy carve out because you didn't do whatever it might be. So understanding bad boy carve outs inside and out, understanding are they limited to the infraction? Let's say I'll give another example because it's super important. Having a lien on your property that's not paid off in an X number of days and cured, provided you're not fighting it, right? You don't have an excuse not to pay it. But let's say you're not fighting it, and then that's a bad boy carve out. Lender says, bad boy carve out, you didn't pay the lien. We're going to sue you personally. And the next question would be, and this is all, that's not a question, it's what's in the loan document. And let's say it was an $80,000 lien. Can the lender come after me for $80,000? Or are they saying, nope, full recourse again, coming after you $20 million? Most of the time for a lien like that, it's going to be based on the infraction, the $80,000. So it's a limited recourse. There are things in loan docs that will say, we, the lender, can sue you even if we, the lender, have zero damages. No damages at all. But you did something, like finance your insurance, which is completely silly. I'm just going to say stupid for a lender to try to say that that's a carve out. Okay. So all kinds of things in there. The CapEx category is important. If you're like, well, we don't really know, we're going to spend $1 million. We're going to put like 200,000 for interiors, 100,000 for parking lot, but we don't really have the bids yet. We're just kind of like winging it a little bit where we think we're going to spend it. You put those all in categories. The lender says, okay, we're going to give you the $1 million of CapEx and we're going to split it up how you told us, Mark. And then you're like, well, you know what, we closed and we're like, oh my gosh, like, you know, we actually need $300,000 in interior and we need like 20,000 for the parking lot and we need whatever it is. The lender's not required to move money around. They might say, well, we don't care. We're still gonna, you know, we're not gonna give you money based on what you think you need now. You told us what you need. And if you ever think we're gonna give you or move any money around, we would consider it potentially as a lender, although we don't have to do it after you get all your other work done. Then we'll see, did you really spend more or less? So it's critical. You have a really good idea where the money is going to be spent. Ideally, you can raise your own CapEx money and not have to deal with lender draws and ask them for money and them shorting you on money and just all that. Hassle is an understatement. You might have to get a general contractor approved up front and a budget approved, and then you're locked into that, GC unless there's some reason you can, use a different one. Don't wait too long. If you're like waiting around, like, oh, we have all these different options, and at some point in time, you're running out of time to do the loan. And again, if you have like a deal and there's only one lender out of 10 lenders interested in doing the deal, probably tells you something about your deal. Lenders are pretty smart. They know what the risk rewards are based on a deal. And if 90% of them don't want to do your deal, probably should send a message to you. All things being equal, select the loan option that requires the least amount of equity for you to raise. This is relative. It's easy for you to raise equity, then, fine, use a lower leverage. But a lot of us have been, surprised before where you get close to closing and the lender, these are real examples, in 2022 where lenders were like the day of, 2 days, 3 days before closing. We, the lender, were changing your proceeds because what's going on in the market over the last couple of days. You guys need to bring, $1.2 million, $1.5 million for closing, tomorrow extra. What? Yeah, happen all the time. I don't know what these lenders think, but believe me, it happens all the time. Will the lender allow distributions? Are there stipulations you have to meet certain debt coverage ratios and things like that? So your loan doc might say, hey, you know what? You guys can't do any distributions until you hit a certain debt coverage ratio. Debt coverage ratio being what's your net operating income, which is revenue minus expenses compared to your debt payment. Okay. Will the lender allow 1031s? I could do a whole thing on 1031s. Critical, in my opinion. You understand 1031s on either side. If you're investing as a 1031 investor, which I've done before, if you're syndicating and bringing 1031 investors in, which I've done probably 30 times, I can tell you there is a lot to it, and it can be screwed up really, really badly. So, yeah, very, very important. But with that said, some lenders won't allow 1031 investors at all. Zero. Some lenders will say you can have 2 or 3 max 1031 investors. Most lenders will say 1031 investors will have to close and be part of the deal prior to you closing on the purchase of the deal. We had one before where 1031 money came in after the fact, and the lender actually reopened the loan and allowed us to do that. And they charged $50,000 to reopen the loan to do that. So can't stress enough understanding 1031s and how it all works. What are the key principles? Equity contribution requirements. Some lenders will say that the key principles, you need to put 10% or more of the overall equity. So if you're raising $5 million equity, the KP or KPs would have to bring $500,000 or more of that $5 million. Now, what you want to have in the loan docs are, terms, if you want to say, that say, no, it's not the KPs that have to bring, or guarantors, right? They have to bring the 10%. It's all the GPs, which includes going to be the KPs and all the general partners together, probably more than 1 or 2 people there. And then we want to be able to count all of that contribution towards the 10%. If you don't have that in there and you're signing the loan, then there's an expectation that you, as the KP, or maybe you, one other person, whoever it is the KP, are putting 10% or more of the overall equity in the deal. Are you doing that? Can you do it financially? You need to be aware of it. How fast can they close? Some lenders are very, very fast. Other lenders are very, very slow. You get to know which ones are which if you use them enough. Issues with small units, concentration, whether it's student, military. Usually, if it's 20% or more, there can be issues with that. If the unit size are really small, some lenders won't even loan to you. Fannie, Freddie won't even give you a loan. Called micro units. Can you lock the rate day one? Some cases you can. There's a charge for that. So think of it this way. If anyone thinks they know what rates are going to do, and I don't really care who this person is on the entire planet, they don't know what rates are going to do. They have opinions and thoughts, and 99.9% of the time they're wrong, and the 0.01% of the time they're correct. They're like, look at me, how smart I am. I was right. Look, I told you this. Well, you know what? No, you've been wrong way more times than you've been right. So I'm of the opinion if you can lock the rate today and the deal works at the rate you're locking to, lock the rate. Now you might say, well, man, I locked it and the rates came down. Okay, I get that. Well, you could have not locked it and the rates could have gone up, in the matter of 1 week when the 10-year treasury moved from 4 to 4.5, 500 basis points in a matter of 1 week because of the tariffs. This is a real example of what really happened. Our $20 million loan we had would have required us to bring in an additional $1.2 million of cash to close that deal. That's a real number. Like 1 week. So Monday, you have to bring, X dollars. Friday, hey, Mark, you need an extra $1.2 million to close this transaction for the same loan size. Lock your rate. You can be mad at me if you want when you lock it and it goes down, but I tell you, you can be mad at yourself if you don't lock it and the rates go up during the time of a loan. Think about it. Maybe you're under contract for 3 months. Look how much rates can change in 3 months. So now, with that said, some cases you can't lock the rate. Sorry, you just can't. Is a lender also an operator? Meaning they operate their own properties, which translates into I'm an operator, I'm a lender, I'm an operator, and if you're in trouble, Mark, I have no problem taking it from you. I'll foreclose on the property and I'll operate the property. Versus a lender that's like, I have no desire to be an operator. I have no desire to take your property. I want to do whatever humanly possible I can do as a lender to help ensure that you keep the property and we're successful together. Pretty big difference there. I've had both sides of it. I've had conversations with lenders that are screaming, literally F word at me on things for not doing anything wrong, if you want to say, other than, yeah, we're having problems in the property. Didn't do anything wrong, didn't steal anything, didn't do anything fraudulent, but you're just upset with me because, somehow it's all my fault as a borrower, but you as a lender who did your appraisals, did the loan, did your underwriting, have more information than myself or any other price indicator in the world. But you guys also made a loan on this, but you guys didn't predict that rates were going to go up 11 times. You didn't predict that rate caps are going to go up 3,400%. You didn't, predict that insurance is going to go up 300% in parts of, Florida. But I'm supposed to predict that. So, yeah. But those operators, they're like, they'll get in your face, right? And all they're going to do is try to suck you dry of any money they can squeeze out of you. It's the way it works. Does the lender sell loans off? Meaning they sell off the market. Why does that matter? And then the reverse is, do they keep it on their own balance sheet? They keep it on their own balance sheet. They have a lot more leverage. Doesn't mean they have to work with you, but they have a lot more leverage what they can and can't do. Then when they sell it off, there are going to be a lot of rules, regulations, timelines. You get 60 days, for example, being default on your mortgage. There's a whole ramification process that starts when that happens, when loans are sold off. And the ability to revise a loan and a loan modification will be much more limited if your lender sells a loan off. What are the prepays, rate caps, interest reserves, all those things? It's not just the loan proceeds. There's all these other things. I'll come back to interest reserves in a second here. Cash management, does your lender, that means all money comes in the property. It comes from rents, other income goes into a lockbox. You, as the owner of the property, have zero access to that lockbox, zero. You get no money from the lockbox until the lender pays their mortgage, pays the escrow for taxes, insurance, pays whatever fees you might have, pays forever late, you where you're late. And then they say at the end, is there any money left over? Oh no, I'm sorry. Then you, as the owner of the property, we're giving you no money. And you're like, how would I pay for utilities, water, electricity? Like, what are you talking about? Legit, real example, happens all the time. Cash management can be invoked when you got your loan initially. Never would do that. It could be invoked when there's a default. Understand why a lender might do that, but can you imagine being in a situation where your interest rate goes from 4.5 to 11%? You obviously don't make enough money to pay your mortgage. No property would when that happens, and the lender is going to take all the money collected at the property and give you nothing, or give you what's left over, which probably would be basically nothing. Big problem. Um, Rate cap payments, rate cap would be like an interest rate protection. Think of it as like an insurance policy and how high rates can go. And you uh, get paid in some cases. What do you mean get paid? Like, okay, well, if rates go up higher than what your we call it a strike is, and the rates are higher than that, then you as a borrower will actually receive a check, to the property on a monthly basis. But rate caps is a whole nother thing to understand in detail. I was going to come back just for a second though for interest reserves because I want to make a point on that. Interest reserve is where the lender might give you a loan, and as part of the loan, they say, well, this property isn't really cash flowing. It's kind of more a value add. And we're going to put like 6 months of interest reserves, 6 months of mortgage payments into this interest reserves. And you, as a borrower, can then draw upon the interest reserves if your cash flow is short and you can't pay your mortgage. First of all, I don't want to do deals like this anymore personally. I don't want to do deals where the cash flow doesn't cover the mortgage. But let's say for sake of argument, we've done a lot of deals like this. And, some deals, big value add deals, they're in the situation. So then you start drawing upon that. And, as your rate goes from, 4.5 again to like 11 or whatever it might be, 12, you burn through that pretty quickly. But let's say you're burning through that and then you're into it. And then, well, depending on your loan docs, very, very common that there is a floor or a trigger that says, hey, borrower, once you hit 2 months left, you had 6 months of interest reserves, you hit 2 months, you can use it if you want. But as soon as you go below 2 months, you have to replenish the interest reserve to 4 months. So if that sounds like ridiculous, stupid to you, hopefully it does. So let me get this right, lender. So I got 6 months. I used it to help cover the mortgage, which I needed to do, and I needed to do it. There's 2 months sitting in there, so $200,000 sitting there for 2 months of my mortgage payment, but I can't use it? No, you can use it if you want to. Okay, so if I use it and go below 2 months, then I have to give you not only what I use plus 2 additional months of interest payments. Yeah. Okay. So I'm not trying to laugh about this, but it's like absolutely absurd, ridiculous. You're getting charged on that money by the lender. You can't even touch it or use it. We have an example right now. Lender's been pretty good on this deal. They have. We have $194,000 sitting there in interest reserves, and we're doing an extension. And part of the extension negotiation, they were really accommodating. I mean, in fairness, in a good way. But I said, hey guys, we have $194,000 sitting there. We could use that money. Our rate's like 9.5% on this loan. It's really high, and we could use that money. And they came back and said they did everything else, which I sincerely do appreciate. I really do, because they don't have to do anything. But like, yeah, no, we're not going to let you use that money. It's just like, what? So why do I even have it? Why is the money sitting there? I can't use it, or if I choose to use it, I have to give you all that money back plus 2 extra months. It's like I would just pay the shortage myself. It's just ridiculous. So there are so many things like this where you're just like you don't know until you experience it and get into it, and you're scratching your head going, "This sounds like really weird and strange." It is weird and strange. So hopefully it does sound weird and strange to you. Some tips for due diligence. My opinion, use the same due diligence company over and over again, provided they're good. You know what you get. If you're going to go to a new due diligence company, make sure you get a report ahead of time. We've had reports that were really bad. We had reports really good. We have some due diligence companies that will say, "Oh, we're not going to give you any bids or estimates that any of the work needs to be done unless it's over $5,000." I'm like, what? What? Like, a lot of $5,000 bids could be a lot of money. So you go into a unit and it needs $4,000 of capex to get it up to snuff, and you go another one needs 3,000, and then none, and you're not going to tell me that? No, we don't do that. It's only if it's above $5,000. So make sure you know what you're signing with every single thing, whether it's loan documents or property management agreement or a contract on the buy sale side, due diligence material, you name it. Make sure you know what you're signing and understand it. Walk every unit without fail. We had 208 units, and there were 36 or 38, I don't remember, units we couldn't get into day one. The keys didn't work, right? So said, then they said, oh, well, the tenants changed the lock, but they're not, tenants aren't supposed to change the lock, right? So we said, drill them. They drilled all those units, and we got into every single one of those units. And people are like, well, I don't know what the tenant, oh, I don't care what the tenant's gonna, what they say or care. I mean, I'm buying it for one. I'm getting it in the unit to see it. And the tenant wasn't supposed to change their lock. Too bad. It's on them. So, don't give up on things like this. Because if they're like trying to push you off, and at some point in time, you need to get in the unit to see it. I mean, you might have $30,000 damage in a unit. You think, you're estimating $2,000. Don't try to scam. Scope plumbing. Will you scope 100% on plumbing lines? Typically not. I'm not saying you shouldn't. Typically, we start with 25%, and if we found issues, then we would go scope more lines. But we have found things like big ticket items, like plumbing is a huge, huge thing, especially in older buildings. I told you the one that's like a $131,000 collapsed pipe that we would not have found if we didn't scope the line. And those are things where they're hidden, right? I mean, you can't see that with your eye. Identify areas that will increase your capex, and this could be creative. I mean, we've had places before where it was a den, but it had a window in the den, but no closet. And so we changed those. We turned them into two-bedroom. Actually used a farm door for those, made it a bedroom, or I had a window, so it had, the ability to get out in case of a fire and things like that. And we put these like built-in closet type things so that it looked like a bedroom. I mean, the amount of money that can be increased by doing that is substantial. We had another property, 255 units, and it had, I think it was like 46 of these three bedrooms. And we went in there when this was during due diligence, and I'm like, this is bizarre. This was like two different units at one point in time. And it had a separate kitchen that wasn't active, by the way, but you could tell that our kitchen was here. So we were like, we're gonna change this back into like a two-bedroom and a one-bedroom, or a two-bedroom and an efficiency. And you start doing the math on that, and then you put a cap rate on it. It's like, woohoo, this is gonna be like substantial, like huge, huge increase in NOI, right? Well, we found out during that due diligence, I don't remember how we even knew this to be in looking back. I know it now, but I'm glad we knew it. The city had a certain number of parking spots required per unit, right? So it was like 1.5 per unit, and it was already really, really tight. And in fact, they had grandfathered in the parking situation of this property. It was a 1969 property. People are parking on the street, things like that. So long story short, even if we would have been able to execute on the conversion of the three bedrooms, right? The city wouldn't let us do it because there wasn't enough parking, and we didn't have an alternative. Like we're like, hey, we could buy a little bit of land next door to do it, things like that. So same with I can't tell you how many people think like they're going to do things like add value by putting washer and dryers in there. And then depending what's electrical, whether, in any of the water for the washer, wash machine, things like that. And there's not capacity. Like there's not enough capacity in electrical units to support it. The water isn't, set up to do it. So you have these grand scheme plan where you think you're gonna add all this NOI, but you actually can't execute on it. Those things you have to know ahead of time before. And if you don't know ahead of time, don't assume you can do it, meaning your business plan needs to work without it. And if you're able to execute on it, it's just gravy. Financial due diligence, lease audit, bank recs, things like that. So very, very important.